Welcome back to my financial literacy corner. This is a continuation in regards to what decentralized finance is. Yesterday, I had just given a brief overview. Today, I want to go into the lending aspect of it. So, let me go ahead and just, for those that are tapping in, start over. So, decentralized finance is a peer-to-peer blockchain-based system that allows users to lend and borrow crypto assets without intermediaries like banks. It uses smart contracts to automate loans, manage collateral, and set interest rates. Lenders deposit funds into pools to earn interest, while borrowers provide over-collateralized assets to secure loans. So this is how it works. Decentralized protocols. Platforms like Aave and Compound operate entirely through code, smart contracts, removing the need for a central authority or credit checks. Also, such as like with the Metallicus blockchain, there's aspects of Hedera's blockchain, there's aspects of Stellar's blockchain, and even with XRPL as well too. They all have their own protocols and how they utilize their liquidity pools and the like. So you need to do your due diligence on how each one of those blockchains act when it comes to their lending protocols. Speaking about liquidity pools, lenders, liquidity providers, deposit crypto assets into a shared pool, earning interest on their deposits. So you basically you take your assets, you'll put it into a pool with other individuals, and then from that liquidity, that is to where you guys will start gaining interest on what you put up. Now the over collateralization portion. Borrowers must lock up cryptocurrency worth more than the amount they borrow to ensure security. For example, to borrow $500 worth of USDC or United States dollar coin, a user might need to lock up $1,000 worth of ETH as collateral, just to give an example. And then there's automated liquidation. If the value of the collateral drops below a certain threshold, the collateralization ratio, the smart contract automatically sells the collateral to repay the loan, protecting the lender. Now, here's some key benefits in regards to it. High yields. Lenders often receive higher returns than traditional savings accounts. Now you see the reason why the banks were given held in regards to this Clarity Act, and why they didn't want the exchanges for people to start gaining on their yield in regards to like their stable coins and stuff, because they said it's too much like a savings account because you have a higher yield return ratio than them. That's the reason why. Accessibility and speed. Anyone with a crypto wallet can access these services 24/7 without KYC, which is know your customer requirements. Transparency. All transactions and terms are visible on the public blockchain. No credit checks. Loans are approved instantly based on collateral, not credit history. Now, of course, there are some risks involved. There are smart contract risks. There could possibly be errors in the code that can lead to a security breach and loss of funds. Market volatility. The high volatility of crypto collateral can lead to a sudden automatic liquidation of assets. And then there is the liquidity risk. In some cases, lenders may not be able to withdraw their funds immediately if they're all loaned out. That is why I said you must do your due diligence in regards to what blockchain and what DeFi protocol, the lending and borrowing, plus the size of the pools, and what is the total value locked. Once you look into that information, that is when you should make the choice and decision to say, this is where I'm going to put my money in for financial cases. Common uses for it. Yield farming. Deposit assets to earn, not just interest, but additional token rewards from the platform. Leverage. Borrowing assets to buy more crypto, amplifying potential gains. So you can borrow against that to buy some other cryptocurrencies. for my traders as an example. And then once you get that from what you've traded out on the other end, then you can take what you've made from there and then pay back the loan and then have your extra. And then tax management. Borrowing against crypto holdings to access liquidity without selling access and triggering capital gains tax. Look into that most definitely. So that is to explain a little bit more about what DeFi lending is and why now it is one of the best things for you to be able to do in regards to maximizing your yield. Like I said, do your due diligence research on the blockchains, protocols, methods, and everything else. So you are making the correct financial choices and decisions for yourself, because it's not about just buying, holding, and waiting for the market to go up so that way you can make this amount and that amount. Yeah, that's your traditional trader's perspective, because they have to wait on the marketplace in order to move, versus your actual investors, which look at the different vehicles to make their assets compound and gain interest over time. So that is so that way you'll know, like I said, in regards to that. One other key thing as well, in regards to like the loans and stuff, there are two components needed to make decentralized lending possible. The first is making sure that the loan record is not fungible. Blockchain data immutability makes transactions irreversible. Is the key to making digital assets viable, because every data block, which is transaction, is timestamped. It is chronologically chained. And because this chain is cryptographically secured and synced between hundreds or thousands of network nodes, it is virtually impossible to falsify a transaction. Like literally. So between a blockchain and a smart contract, then it is possible to create peer-to-peer lending without banks and without the borrower or lender ever knowing each other. And just like I said beforehand, the lender deposits cryptocurrencies into a smart contract. The purpose of this smart contract is to pool funds, creating a liquidity pool. Just like a bank has its vaults, the borrower accesses this liquidity pool to borrow funds under the conditions set by the smart contract. That is why I keep saying you must look at the blockchain, the DeFi protocols in the blockchain, and what the use cases is for it. These smart contract conditions range from loan principal amount and APR, or annual percentage rate, to the type of collateral used to issue a loan and the loan liquidation threshold. So make sure you do your due diligence and research. But this is now, you know, what on the lending aspect of what DeFi is. I'm going to get into the borrowing aspect of DeFi as well, so people will know the base information in regards to what decentralized finance is, so that way when people are excited about their favorite blockchains and how they have their protocols and everything else like that, they do not explain this half the time, because the only thing they do is just talk about their favorite protocols on their favorite chain, not looking at DeFi as a whole and the multitude of different lending protocols that are out there. Look up the legitimate lending protocols as well too. That's the other thing that I stand by. If it's not being officially announced, like either on their Twitter profile or from the direct website, or when they're having these their meetings and they're posting them on like YouTube or other channels and stuff like that, if they don't do that, then I wouldn't do it. Just like some bona fide noted from directly from the blockchain developer in itself. Here is just a couple of them for you. One, which is Metallicus or Metal X Lending. Another one, which is StellarX.com. That is the direct DEX to Stellar Lumens or XLM in itself. So for people that like to do stuff with XLM and want to get into liquidity pools, into DeFi and other stuff like that, StellarX is one of the good ones for you. Even in the case for the people that like using XRP and Ripple, xmagnetic.org is also a DEX that is built onto the XRP ledger system in itself. It is legitimately from that. It is one of the ones that David Schwartz has set up there and built upon. It was talking about the automatic market makers in itself, which is xmagnetic.org, and it's directly on the XRPL. Not only can you utilize your RLUSD, but you can also utilize your XRP and other things on there too, just to let you know. Or even with Stater Labs, which is a bona fide DEX and liquidity pool, so you can stake not only your HBAR and other stuff. And then you have Saucer Swap and Bonzo.finance, which is directly with Hedera in itself, because the H Bar Bull, Brandon the H Bar Bull, who is an individual that I do follow, who is a direct spokesperson for Hedera, is always talking about and promoting Saucer Swap or Bonzo.finance in regards to utilization with the DeFi protocols, in which when you go and read the white paper and go and link up with that, you can actually see everything is there. So that's what I mean by legitimate, bona fide, decentralized platforms that you can get on, so that way you can network with these blockchains. But this is the base information that you need to know, so that way when you are choosing a blockchain, or when you are choosing your favorite assets that you're wanting to put into a decentralized protocol or DeFi protocol, you have the understanding of what lending, borrowing is, how you put your assets in there, and the like. But always do your research and due diligence on that. And thank you for coming to this financial literacy corner.